The S&P 500 is sitting at 7,500 right now, and I'm going to tell you something that 90% of traders don't see. There is one danger zone and one hidden opportunity forming at this exact level, and I'll show you both. But here's what makes this setup so dangerous. The market looks bullish on the surface, but beneath the hood, everything is screaming exhaustion. Stay to the end because I'm giving you 3 exact levels you can trade today, including a sniper entry that most retail traders will completely miss. Here's the verdict on today's session: trending, but barely. We are seeing higher prices with weak participation, and that's the first red flag. The S&P 500 is up 80 points and change. A 1.08% move that feels strong until you look at the internals. Volume is light, and the ATR is sitting at 112 points. That's telling me the market's range is contracting even as price pushes higher. This is a divergence that most traders overlook. Write this number down: 73.71. If we break below that support level today, the entire structure resets. Now here's what the herd is doing. They're piling into calls at 7,500 thinking this is the start of a massive breakout. But institutional flow tells a different story. Hedge funds have been trimming their net exposure even as price climbs, and that's the kind of positioning that sets up a sharp reversal. The herd is positioned for a breakout. The smart money is positioned for a trap. Let me walk you through this chart from the weekly down to the 60-minute. Because this is where the real story lives. Starting on the weekly time frame, this is strong buy across all indicators. There's no debate about that. The 200-week moving average is sitting at 68.83, acting like a foundation that's miles below current price. But that's not what matters right now. What matters is that we're approaching a major structural level. On the daily, we are also strong buy, but I want you to look at the MACD. It's positive at 38.91, that's fine, but the momentum is decelerating. The slope of the MACD line is flattening, and that's a classic sign of buying exhaustion at resistance. The RSI at 55.07 is neutral, which means price can still move higher, but the Williams are at negative 31.4 says we are starting to get overbought. Now drop down to the 4H chart, and this is where it gets interesting. The 5H trend is also strong buy, but the ADX is only 20.5. This is telling me the trend strength is weak. Anything below 25 means the trend is losing conviction. We have a trending market with no trend strength. That's a contradiction that usually resolves with a sharp move in one direction or the other. The key technical picture right now is a market that's pushing into resistance at 7,500. That's a 1 on my levels today, while momentum indicators are rolling over. Look at this 4H. Negative divergence starting to form. Buyers are exhausted. Each new high is coming on weaker and weaker momentum, and that's the setup for a liquidity grab. Here's what most traders miss: the support levels below. S1 is at 73.71, S2 at 73.22, S3 at 72.41. These are the zones where the institutional bids are hiding. Above, we have a 1 at 7,500. We are literally sitting on it as I speak, a 2 at 75.81, and a 3 at 76.30. The pivot point is at 74.51, and that's the level that matters for tomorrow's session. Let me be specific about the moving averages because this is where the technical story gets really interesting. The 5-day MA is at 74.65. The 10-day is at 74.67. The 20-day is at 74.48. All of these are below current price, which is bullish in a textbook sense. But the 50-day moving average is at 73.13, and the 100-day is at 71.33. Here's the critical insight. Price is trading almost 300 points above the 50-day moving average. That's an extended condition. The 200-day at 68.83 is over 600 points away. When a market gets this stretched from its longer-term moving averages, it becomes vulnerable to a sharp mean reversion move. And that's exactly what the VIX structure is telling us right now. Without getting too deep into the volatility surface, the futures curve is pricing in a move that's larger than what options are implying. That's a sophisticated way of saying the market is expecting a spike in volatility very soon. I'm also watching the Nasdaq divergence closely. While the S&P is pushing against resistance, the Nasdaq is showing similar exhaustion patterns, and this cross-asset linkage is critical because the tech-heavy index often leads the broader market. If the Nasdaq rolls over first, the S&P will follow. The 4H negative divergence I mentioned earlier is the real signal here. Price is making higher highs while the MACD histogram is making lower highs. That's textbook bearish divergence, and it's a setup that has historically preceded moves of 50 to 100 points in the S&P. Now let's connect this technical picture to the fundamental drivers because the news flow today is telling a very specific story. The 24-hour news cycle has been dominated by three key narratives: SpaceX, OpenAI, and Anthropic, and their potential S&P 500 inclusion question and investment fallout. This is massive because the S&P 500 Inclusion Committee has been under increasing pressure to add these high-growth names, but there's a catch. Adding them would change the sector weightings dramatically and could trigger massive rebalancing flows. This is the kind of fundamental event that institutions are front-running, and it's part of why we are seeing this push into resistance. The question is whether the inclusion comes through or not. If the committee delays or declines, we could see a swift unwinding of the speculative premium built into these names, and that will drag the entire index lower. But here's where it gets even more interesting. The AI investment fallout from these announcements has created a bifurcation in the market. Large caps are benefiting from the narrative while small caps are getting left behind. That's not a healthy market structure. When the rally is driven entirely by a handful of names while the rest of the market languishes, it's a red flag. The dollar killer story is also relevant here because the S&P 500 is heavily influenced by the dollar's movement. A stronger dollar pressures multinational earnings, and we are seeing some dollar strength as interest rate differentials remain wide. The bond spread between the US and Europe is driving the dollar higher, and that's creating headwinds for the S&P's earnings outlook. For the 1 to 2 week directional lean, I'm neutral to slightly bearish. We are at a critical inflection point at 7,500, and the preponderance of evidence suggests this level holds as resistance. The invalidation level is a daily close above 75.81. If we take that out, the next leg higher begins. But until we see that, I'm favoring the downside. Do you think the S&P breaks 7,500 this week? Comment yes or no. I'm tracking consensus and I want to see what the audience is thinking. Most people skip this section. That's exactly where the money is made. Keep watching because I'm giving you 3 actionable strategies with exact price triggers right now. Strategy 1. The sniper, conservative. Here's the conservative play for traders who want a high probability setup with limited risk. The trigger condition is simple. We wait for price to touch 7,500 and show rejection on the 4H timeframe. Specifically, I want to see a 4H candle that closes below 74.75 after touching 7,500. That's confirmation that the resistance is holding. Entry price is 74.60 on a 4H close below that level. Stop loss goes at 75.30, which is above the resistance level and gives the trade room to breathe. This stop placement is above the recent high, so if we get stopped out, we know the breakout is real. Target 1 is at 73.71. That's S1 support. Target 2 is at 73.22, which is S2. The risk-reward ratio on this trade is approximately 1 to 3.1. You're risking about 70 points to make 230 points. That's excellent risk management. Here's what voids this setup entirely. If we get a 4H close above 75.81, the bullish breakout is confirmed, and this trade is invalid. Do not take it if that happens. Entry, 74.60. 4H close below 74.75, stop loss, 75.30 take profit 1, 73.71 take profit 2, 73.22 risk, air reward, 1:3.1 are invalidation. Void if 4H candle closes above 75.81. Strategy 2, the active trader, standard. Now for the active trader, who wants to be in the market with a standard position size and a pullback entry. This setup triggers on a pullback to the pivot point at 74.51. I want to see price come down to that level and show a bounce on the 1H timeframe. The bounce confirmation is a 1H candle that closes above 74.65, which is the 5-day moving average. Entry is at 74.65 on that 1H close above the MA5. Stop loss goes at 74,000. I know that's a slightly wider stop, but it gives the trade room if there's a liquidity sweep below the pivot before the move higher. The reasoning here is that the pivot can get taken out briefly before the bounce, and I don't want to get stopped out on a fake breakdown. Target 1 is at 7,500, which is the resistance level we've been discussing. Target 2 is at 7,581, but I'm going to give you a trailing stop rule. Once target 1 is hit, move your stop to break even and let the trade run toward target 2. This way, if the breakout happens, you capture the upside without risking your profits. The risk reward on this is approximately 1 to 1.7, which is acceptable for a standard setup. The active trader, standard, entry, 7,465, 1H close above MA5, stop loss, 7,400 take profit 1, 7,500 take profit 2, 7,581 risk. Reward, 1:1.7 R invalidation. Void if 1H candle closes below 7,400. Type your S&P 500 target for tomorrow in the comments now. Let's see who's aligned with the institutional flow. Strategy 3, the aggressor, high risk. This last setup is for the aggressive traders, those who can handle high volatility and have the discipline to manage risk aggressively. This is a counter-trend play, and I want to be very clear about the risk profile. We are looking at a sharp move up to 7,500. And I want to enter a short position on a 60-minute breakdown below 7,480. This is essentially betting that the rejection at resistance is swift and violent. Entry is at 7,480 on a 60-minute close below that level. Stop loss is very tight at 7,540, just 40 points above the entry, because if we are going to see a breakdown, it should start moving in our direction immediately. If it doesn't, we are out. Target 1 is at 7371. The S1 support level. Target 2 is at 7322. The risk reward is approximately 1 to 4. You're risking 60 points to make 220 points. That's a high reward to risk ratio, but it comes with the understanding that this trade is high probability of getting stopped out quickly. Only take this trade if you can handle a swift loss and move on without chasing. This is not for beginners. This is for traders who understand that aggressive setups are about high reward but carry high risk. I'm showing it to you because it's a valid play at this price level, but the execution needs to be surgical. The aggressor, high risk, entry, 7,480, 60-minute close below, stop loss. 7,540 take profit 1, 7,371 take profit 2, 7,322 risk, reward, 1:4 R invalidation. Void if 60-minute candle closes above 7,540. Never risk more than 1 to 2% per trade. No positions through high-impact news events like tomorrow's economic data releases. Stops are non-negotiable. If you don't use a stop, you're not trading, you're gambling. This is how you survive to trade the next big move. The market will always give you another opportunity. The question is whether you'll have the capital to take it. Let me summarize what matters most for the next session. The single most critical level to watch is 7,500. It's the line in the sand for the entire market structure right now. If we close above 7,581 on the daily time frame, the bullish breakout is confirmed, and we are looking at a move towards 76.30 or higher. But if we reject and close below 73.71, the downside acceleration could be sharp and fast. Tomorrow, I'm focused on the AI inclusion story and the potential fallout from the SpaceX and OpenAI news. The investment community is still digesting what these announcements mean for the broader market, and I think we'll see significant volatility as the picture becomes clearer. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen to watch the institutional view on crypto and equity correlations. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.